G'day guys, it's Ben and Simon. Welcome to the Pumped On Property Show. How you doing, dude?
Yeah, good. It's good to be back.
Sick. In today's episode, we're going to be talking about the big rocks when it comes to property. But before we get into that, heaps has been going on in both our lives. So why don't you share what's been going on in your world?
It's been a really massive start to the year, actually. It's so much. Obviously we're based up here on the Sunshine Coast in Queensland, but I think we're only into the, sixth week of the year, and I think I've been back down to Sydney like 4 times, just for, unforeseen circumstances and planned trips and things like that. But it's just been super hectic, just moving back and forth, which has been gnarly, but pretty excited to just be a bit settled now. I had my property settled last week, as you know.
Awesome.
Yeah, we spent a bit of time down there over the weekend doing some renovations. It was a good day, hey?
It was so much fun, man. Like, we actually just all went ham on it. Yeah. It was so fun.
It was a big day. Like, 15 minutes into the day, we were all dripping with sweat, and that just maintained throughout the entire day. It was like 35 degrees, humid as it gets. And
I got a really shitty, really weird video where I was just sort of following people around at different parts of the day.
Yeah, if you guys
want to check it out on YouTube.
Yeah, we all look pretty weathered by the end of that, sitting around having a beer.
It was sick. One of our clients from Melbourne, George, stopped in and bought like a 6-pack of beers for the boys, which is cool.
Yeah, legend.
That was a big day. I was definitely sore for the next 2 days after it.
Yeah. I actually got a bit sick after that. I think it was the mulch. I didn't have a little face mask on. For those of you guys that are going to do some DIY landscaping, wear a mask when you're doing the mulch, because that bacteria gets right up in there.
I don't know if it was that or the asbestos, bro. We'll have to wait 20 years and see.
Yeah, what about yourself? What's been going on in your life?
Same as you, like, it's been a cool start to the year. We had what I reckon was the best chat we've had in the business since we started on Monday. Just sort of talking about our future and what we all want and what we all like doing and what we're all good at, and how we want to spend our time moving forward. So that was super meaningful for me. I also bought a piece of land unexpectedly last week, which is sick. So negotiated a 60-day settlement on that one. Lisa and I sat down the last couple of nights and have been nutting out a plan, which is pretty cool. Like, it's fun to be in that creative front end stage again. So that was a nice big block, which we're going to build a 3-bedder with a 2-bed granny flat on it.
Oh, nice.
And it's just like a little bit of fun starting to work through that creative thing again, and talking about like stuff that I nerd out on, like what flooring we're going to put in and what tiles we're going to use and how we're going to landscape it. And
well, it's been a while. Like, it was 2 years ago that you built your last. Oh no, you just finished one actually. Gosh.
Yeah, it feels like that. But I finished my last one in December, which is that subdivision down in Brizzy.
Yeah, that was a long time coming though.
Yeah, but that was kind of like your cookie cutter product, where this is more like your really nice high-end type thing, and it's going to be, that's what I love doing. It's just not every market needs that.
Yeah, it sounds as though like you've kind of molded a really good property investment strategy with a passion of yours plus Lisa's as well, which is going to be pretty fun.
It's like fully Lisa's passion, because my wife's an interior designer, for anyone that doesn't know, and she just loves having a project, and she doesn't really want to go back to work, like with the 3 kids. So this is kind of like our new business, is her looking after all that stuff. But I just can't help to fucking micromanage, and I just keep getting involved in the design, which I really don't have to in any way.
Well, she went a little bit over the top with your renovation on your house, so I think a little bit of micromanagement.
If I don't keep this in check, Lisa's going to spend 50% more on the project than we should be. So, that comes in, and because my attention to detail is good, like, I pick up things that she doesn't. But yeah, it's been fun, like a couple of weird nights sleep, because we've been going to bed at like 10 or 11, sort of planning this stuff out, and really wired. But it'd be nice now that we've sort of nutted out 90% of it, to just take the pressure off, let her go, talk to all the suppliers and find sick product. And yeah, I'll keep you posted. Like, I'll do some walkthroughs of that as we start building it.
I think about 4 or 5 podcasts ago, we were both talking about how we want 2019 to be nice and chilled. And it's like 2 weeks of chill, and we're like, all right, I need to do something.
I really had a goal of not doing a new project this year, but when the right opportunity comes up at the right time,
you've got to take advantage.
You've got to take advantage.
Which is one of the things that we'll talk about today, taking action. So that's cool. Why don't we kick off today's podcast with talking about the metaphor that you were mentioning about the jar and the rocks and things like that kind of triggered this podcast.
Yeah. So everyone's probably heard this before, but apparently a university professor in America just walked out in front of his lecture and got all of the kids sitting there sort of going, what the hell are you doing? And he put the jar on the table, and then he walked back out and came back in with like some bigger rocks, and he put those big rocks in the jar first. And then he walked out and then he put some smaller pebbles in, and it looked like the jar was full, and he said, guys, is the jar full? And everybody's like, yeah, the jar's full. So he went and got a bag of sand and tipped the bag of sand into the rocks, and it looked like the jar was full. And he's like, guys, is the jar full? And everyone's like, yep. And then he went and got water and he poured it in until it was overflowing. He's like, now the jar's actually full. And he's like, what can we learn from that? And I think that's what inspired this podcast, is if he had have put, the sand in first or the little pebbles first, he wouldn't have been able to fit the big rocks in. And a lot of people fill their lives with the water. Like, a lot of people fill their lives with the sand and the little things, the keeping busy, the not focusing on the big rocks. But in property investing, in business, in your job, with your family, in your life, the big rocks are the things that really matter.
Where you should be focusing majority of your time.
Yeah, because you can't fit those big rocks in unless you start with them in an appropriate way. And I think that's what he was trying to get to. Like, you really can't focus on the one or two most important things, if you're focusing on all the little things that are just chewing up your time, your attention, giving you anxiety, or all of those other types of things.
I think that's just so fitting with property investing, because you talk to so many people and everyone gets caught up on realestate.com looking at houses in 1,000 different suburbs all over Australia, and it's like, that's the water, guys. That's the water. That's the last thing that you need to be focusing on. There's the big rocks that require a lot of your time and a lot of your focus and a lot of your attention to make sure that when you get to adding the water, you're doing it right.
100%. Like, how easy is it to put the water into the jar when the big things have already been sorted? And I love that. Like, realestate.com's the water. The media, the sentiment, the availability of getting money, what the government's doing, where the cycle's at is the sand. And then we start getting into the more important things like the fundamentals and the action taking, which we're going to talk about today.
Yeah, so let's start talking about what we consider to be the big rocks when it comes to property investing. And I think the most important one is having a strategy, having the right strategy, and understanding where you want to be going with that as well and how to implement.
For sure. Like, in previous podcasts, I think you and I talked about that epic Jim Rohn quote, which is, it's not the set of the sails, it's not the blowing of the wind, but the set of the sails that gets you to your destination. And I've also heard it from the guy, I think Jack Canfield, who wrote that book, Chicken Soup for the Soul. And he's like, you cannot drive 3 hours into the future without just focusing on your immediate next step. And I think so many investors that we talk to are so concerned about their big picture, their long term, but they're not clear on it, that they're forgetting to just create a strategy that works for that immediate next step. So we'll sort of talk about that. But what does strategy mean to you now? Because strategy means different things to different people.
Strategy to me means having a defined set of rules that you're going to follow to help you achieve your longer term goals.
I completely agree with you. Like, a strategy is just a clear plan. Think of it like a business plan or a blueprint for what it is that you want to achieve. So strategy will actually, we say it's strategy, but the reality is it's applying these goals, your goals for the next 12 months or the long term, applying these fundamentals. And I suppose those fundamentals plus goals plus what's going on in your life define the action or the strategy that you take. So strategy is just the collection of all of that big stuff in a really, really concise series of dot points that you follow and you don't deviate, which makes it much, much, much easier to buy as an investor and much easier to get what you want long term as a human.
And I think the hard thing is that there's so many different opinions, so many different strategies out there that it can be so hard to figure out exactly what's right for you.
Yeah.
So taking a broader approach and focusing on those longer term goals, and then figuring out what the right strategy is, taking into consideration your personal goals.
Yeah, for sure. So, let's break this down. Like, what is your personal investment strategy right now?
My personal investment strategy is focusing on residential housing in Australia. So I guess in simple terms that. Now, the next thing for me is to acquire a small number of really high quality investments that I never have to sell.
Awesome.
So it's not about acquiring shit, it's not about getting the pebbles, it's about the big rocks for me, and just acquiring a couple of great properties that over the next 60 years that I live, maybe more, are going to just continually provide me with one, capital growth, and two, really strong cash flow.
Awesome, and we'll get back to that as we go through this. Like, I don't want to sort of jump the gun around fundamentals, because obviously those fundamentals have been applied to your strategy. Mine's the same. I just want to take what I've learned over the last 10 years and what we've learned in the business over the last 5 years, and just slowly, strategically, safely enter the property market when it is the right time for me and the right time in the market cycle, and take advantage of those conditions with the same intention, which is creating a passive income stream for life, which allows me to take the pressure off myself, and also gives me an insurance policy in the future that if I decide I don't want to work, or if I can't work, or if I want to set up a bit of a legacy for my kids, or if I just want a passive income stream in the future on top of what I'm doing because my business doesn't work for some reason, then that is just sort of the safety net, the insurance policy. Because most people listening to this in reality, even if you're financially free, aren't going to stop working completely, or not for more than a couple of years, because you'll be bored shitless. Like, you've got to do something, and so that something may not be exactly what we're doing today or what you're doing today, but it would be something productive for the benefit of society, because everybody listening to this is that personality type, right?
You're out of the rat race, so you're not forced to grind away at a job that you don't like. Like, you've got an income there, so you can spend time focusing on what you're passionate about, how you want to give back to the world, and those sorts of ideas are going to start flowing when you don't have the burden of having to hold a job.
Without a doubt. So let's talk about the next big rock, which Simon and I both agree is goals. So goals come into two categories: short term, long term. Short term for different people means different things. For me, it's about a 12-month period. Long term means different things. But for me, long term, somewhere between 5 and 15 years, depending on how much pressure I'm putting on myself at that time.
Yeah, it might sound like long term for us is a year or so right now after some of the things that we're doing. But no, we always have a long term approach, and I think when setting goals, you need to understand where you're going to be happy in the future. What do you need in your life to be happy in the future? And be realistic. Like, everyone can shoot for the stars, but I think during that exercise, setting your long-term goals, being realistic and going, okay, well, what do I really need? What does my family need to have a happy and fulfilling life?
Yeah.
And then scaling it back to, okay, well, what do I need to do in the short term, the next 12 months, to help myself get closer to the longer term goal?
I love that. Like, a great question to ask yourself for long term is, what would my ideal day, month, or year look like? And sort of just journal that out. Like, that's not like dot pointing, this. It's more like just freestyle it, and over a page, then go back over that page and kind of circle some of the things that would really make you happy. Because I think having a really strong driver, now for me, that looks like doing business that I enjoy, spending heaps of time with my family, traveling, getting to hang out with epic people like family, friends, and just training, staying healthy, like looking after my mind, my body, spirit, hopefully helping other people a lot more in the future as well. you know, for other people that could be completely different, you know what I mean? Like, happiness might be Lamborghinis or Ferraris for some people, mansions on the water. It could be, you know, just completely disconnecting and going living a completely solitary life in the hills of Byron Bay. You know, it's funny how that solitary life up there costs you $3 million now.
Yeah.
So you better get some cash if that's what you want. But you know what I mean? Like, it can look so different. It could be you could be a Buddhist monk meditating on a waterfall, or you could be interacting with society.
And that's the cool thing, like there's no one size that fits all. Like there's so many different things, different moving parts, different personalities, different drivers that need to be taken into consideration. That's why, you know, sitting down with yourself or your spouse and spending some time like going, okay, if I didn't have to work, what would my life look like?
I haven't heard that word spouse since about 1892. No, it's just, hey spouse.
I like it. I think it's good.
I like it too.
It's a good word.
So let's talk about 12 months, because I don't get too caught up in the long term. I have a loose idea of, you know, this beautiful life that's pulling me forward, but as we've all talked about before, being present today and over the next 12 months, knowing where you're going is very helpful to achieve stuff. So how do you link the 12-month goal to your longer term in terms of your 12 months is effectively your next step, like from a property perspective?
Yeah. It's, you know, I guess it's the action that you need to be taking in the short term to get yourself closer. So
what actions should someone be taking if they're just getting started? And then let's talk about some action someone could take if they're in a strong financial position.
Okay, cool. So someone like myself, I've kind of just been getting started over the last couple of years. Now, the first thing that I did, which I guess this goes into the next stage, which is another big rock, which is the fundamentals. So I guess your short-term 12-month goals is filled up with these fundamentals. So getting educated, doing the research and generating the strategy is essential. That's where you need to start. You need to figure out what strategy you're going to be implementing. Then you need to go and figure out, okay, well, how can I correctly execute on that strategy?
I love that. So for someone who doesn't have any money in the bank, getting a plan in place, going, okay, I loosely know I want to buy Brisbane or Adelaide or Perth or wherever, and then going to buy that market in terms of the high quality house I want. And we'll get to fundamentals in a moment, so you know exactly what you should be buying if you want to beat the averages. And then going, cool, I've sort of got a market. I know that I might need I need $400,000 to buy in Brisbane. You know, the bank's going to want me to have 10% of that. So I need to save 40 grand plus closing costs on top of that, which are about 6% of whatever purchase price you buy. So 6% of 400k is about another 24 grand. You know, there's a goal. Like, I need $60,000 to buy this first property. Now, if you're starting at ground zero, then that feels tough. And it took me a few years to save my first one, same as Simon.
Yeah.
But there's some cool grants if you're just getting started in a lot of the states in Australia right now as well, which really help. So, you know, maybe it's a savings goal. Maybe it's going and talking to a bank or a broker saying, you know, how much money do I need right now to buy a property worth this amount, and getting educated. And then using your strategy to determine what it is you're going to actually, you know, need to put together. But then there's these other people, like a lot of the people we speak to, that have a home with some equity in it, or have an investment property with some equity in it, or have good cash in the bank.
Yeah, have good cash in the bank.
Like, so many Aussies have good cash in the bank right now because they've been sitting on the fence for a couple of years waiting around. Yeah,
most people spend, you know, 6 years working, you know, maybe in an apprenticeship or just getting started in a professional industry, and are focusing so much on their occupation, which is great because you need to learn that stuff, you need to get better. And they've been saving away, which is epic.
So there's people that, you know, do have good savings at the moment or good equity. Like, what does the next 12 months look like for them? You know, obviously there's two decisions. There's to do nothing, which is completely cool. I've had years like that. In fact, most of my time investing has been like that. And then there's people that are considering taking action this year but might be concerned about whatever, you know, the availability of money, an election. They might be concerned about the fact that Sydney and Melbourne are declining. So because they're declining, they haven't really looked at other markets. They might be concerned with the fact that they don't have a clear strategy in place. They might be time poor. What does a 12-month plan look like for someone like that?
I think it still comes back to research and generating the strategy, figuring out what you want to achieve in the longer term, and then coming back and maybe talking to some people, talking to some friends that have invested in property before, friends that are financially free, maybe talking to mortgage brokers to figure out exactly where you're at, and rather thinking that what you've heard on the news is gospel, actually talking to a professional who's doing it day in, day out and knows what is realistic.
Yeah, I agree with you. The 12-month goal is effectively, I want to buy a property and I want to spend this amount and this is my strategy, and then just getting on with slowly making it happen. Not saying go out there and buy it straight away, but build a plan, research the marketplace, and get your confidence up so that when you do pour in that water and jump on realestate.com or start talking to agents, you know exactly what it is that you're doing and why you're doing it. Sweet. So let's talk fundamentals.
So in Australia, there's a set of fundamentals that we like to follow to do our best to beat the market average year on year or over a longer period of time.
Yeah, because we all know that, let's say you had $1 million today and you were able to get a 4% return on that money over the next 15 years, just from, getting your average property in your average market, or you had the same $1 million, which might be one or two properties that grow in value by 6% a year. The difference in terms of your position over the same 15-year period, just by getting that extra 2% per year, might be almost $600,000, which is just insane. That's $600,000 in 15 years that so many investors are leaving on the table by not following these fundamentals. So these are really the rules that Simon and I have created for ourselves, so we don't make huge mistakes and we get not just the cake, but we get the cream and the cherry out of every market that we're buying in.
Yeah, so the first thing that we follow is always major metro markets. So we consider that to be Sydney, Melbourne, Brisbane, Perth.
Yeah.
These are the areas that have historically had the strongest price growth in Australia. They've historically had the strongest population and job growth over the longer term, and they're also predicted to have the strongest population and job growth moving forward. Now, taking it to a broader sense, there was an article released from RP Data which talked about metro versus regional. So what they actually did in this article was they looked at the 7 capital cities in Australia. They compared those 7 capital cities to the 7 largest regional markets over the last 20 years. And what was found is the metro markets outperformed the regional markets by 85% over the last 20 years.
That's insane. That's 3% better just by spending the same money in a capital city compared to a regional market. So you could have gone and bought Melbourne for 500 grand, or you could have gone and bought, Bendigo for 500 grand. Your Melbourne property now would be worth, on average, if we're talking averages, 85% better. Now that's we're talking averages here, so comparing one versus the other. Some regional markets have cranked, but that's a big one. That's a really important one. Who wants to leave 85% increase on the table over 20 years? Certainly not me.
Yeah, exactly. And we're not talking about a 2, 5, 10 year journey here. That's 20 years. That's a long-term outlook.
That's long enough to see a trend.
Yeah, which is all we focus on. I think coupling that as well with timing is really important as well, because right now Sydney and Melbourne are declining. So essentially it's not the right time to be purchasing in those markets, but there are other markets in Australia like Brisbane, like Perth, that may be in a better stage of the property cycle to consider. So you've also got to understand which stage of the property cycle those markets are in. And an easy way to get an understanding of that is HTW, which you can find on Google for free.
Yeah, their monthly report, the HTW Month in Review report, can be really handy, as can the CoreLogic monthly housing update videos, which you could interpret all of that information and know more about the Australian market than 99% of people just from spending 30 minutes a month checking out those two resources. So you said metro versus regional. We also mentioned timing, which I think is really important because, you know, you could misinterpret that these fundamentals aren't connected, that buying any metro market at any time will put you in a great position. But the reality is, before the last 6 years, Sydney sat flat for 9 years. Over the last 11 years, Brisbane has sat completely flat, but before that, it did better growth than anywhere else in Australia. Over the last 7 years, Perth has been flat or declining, but the 6 years before it doubled in value. So we don't just want you to be going, okay, I'm going to buy a metro market, and because I'm living in Melbourne, I'm just going to buy Melbourne. Because this unfortunate reality of where Melbourne is right now is it's not going to look good for a while. So you need to come up a level and go, cool, I do want a metro market, and long term, I probably do want Sydney, Melbourne, Brisbane exposure in my portfolio. But right now, Sydney and Melbourne aren't an option, or maybe in the future, Perth or Brisbane aren't. So, you know, you've just got to play the cycle and the timing and make the best decision you can based on what you can afford in your strategy. You know, because it's not really a market that you're targeting, it's a strategy, and the strategy should give you a certain return on your investment. And so you just chase the markets applying these fundamentals that that particular strategy works in.
Exactly. So the next big rock or the next fundamental plus big rock is definitely houses.
This shocked me yesterday when you showed me this data. Like, I actually got you to double check it.
Yeah, so we were looking at another article from RP Data, which is CoreLogic, and they compared houses and units. Well, they didn't necessarily compare them. They were just talking about the growth that these two different assets have had over the last 25 years.
The average house versus average unit over 25 years, Australia-wide.
And houses over that 25-year period in Australia have outperformed units by 96%.
So if you're saying 85% over 20 years buying, you know, Brisbane over wherever the regional market is, and then on top of that you're saying houses at 96%, for some investors that bought regional units 20 to 25 years ago, you've probably potentially in the wrong market cost yourself, you know, 170% in growth. Now that is insane money to leave on the table, which if you apply this fundamental, you never have to again.
Exactly. And now the next one, I think this is a good one that you've really honed in on over the last probably 4 years with your own portfolio, which is quality.
Absolutely. Quality speaks volumes. Talk about the example of where we grew up, which was Engadine in the Sutherland Shire, South Sydney. What a quality property in a nice cul-de-sac like the one we lived in versus a quality property but in a main street or closer to the train station, what that did for prices. You know, what could mum and dad buy them at 20 years ago versus what they're selling for now?
Yeah, so like 20 years ago when mum and dad bought the family home that we essentially grew up in, we spent 17 years there, was I think 380,000,
which was expensive, as I remember mum and dad being like, what are we doing, this is too much money.
Yeah, exactly. That was in 98, I think.
Yeah, sounds about right. And it was like this, I remember, because the house we were living in was a little fibro shack. It was like me and you were sharing a room, Chris and Kai were sharing a room. Mum and dad just had like 4 kids in like a 70 square metre home, but with the best backyard and sickest street. And then we moved to that other house, and it's like, it was a 7-bedroom home on the bush with a pool, and we were just like, we've made it.
Yeah,
we've made it.
It was a huge change, and I guess like we could probably compare those two properties, even though the other one was still in a nice little street. But so that was 380,000 like 20 years ago essentially, and that was expensive at the time. Now 20 years later, in 2019, that property, and Engadine has gone backwards as the rest of Sydney has, and you would probably be able to sell that for at least 1.3 mil.
Without a doubt.
So that's substantial growth over that period of time. Now, 20 years ago, you probably could have purchased a property in in Engadine, on a main street, not the nicest part of the suburb for what, 250?
250, yeah. So the gap at that time was 130,000.
Yep.
And what would that resell for now?
Less than $1 million, you'd say.
Without a doubt. So let's say it's sold for $900,000. You know, what was a $130,000 gap 20 years ago, if you apply this quality fundamental, stretched over time, because the market values quality over time, particularly in residential mum and dad areas like Engadine, stretched to what, $400,000. So when you think about that, you know, no one had an extra $130,000 to spend at that time cash, but mum and dad were smart enough to just put 10% down or whatever they put down, so $13,000, and that $13,000 extra that they spent that probably stressed them out like crazy at the time turned into an extra $400,000 over a 20 or 17 year period. Now, this is important stuff to get, guys, because people, particularly those in Sydney and Melbourne who have made really, really easy money in the last 6 years, think that it had something to do with them. And it did, because you're in the market and you bought, but it had more to do with the market cycle and timing. So as the market rose, all boats rose together, and you haven't yet seen if you bought a 1-bedroom unit versus buying a 4-bedroom home in a quality area of the suburb will do for you yet. But over the next 20 years, you'll see the exact same thing my parents did. And I want people to remember that just because you make good money down there doesn't mean that you're necessarily going to turn that money into good money again. And I don't mean to be like dire on this, but I just see it time and time again. People make really good money on their own home, and then they make a really, really bad second or third or fourth investment decision, and that all of that hard work that their first property did comes crumbling down over time. So buy quality, which means buying close to the city or close to the beach, houses in these metro markets, and sort of package that up as your fundamental strategy.
Now, it's pretty difficult if you're in Melbourne right now and you're thinking that you want to invest up in Brisbane. You're like, well, how the hell am I meant to know what's quality and what's not? Now, there's a couple of things that you can look at, which you can get from, is it demographics.com or?
Yeah, ABS, like Australian Bureau of Stats, or we use demographic or demostats.com.
Yeah, demostats.com, and you can look up suburbs. And what we like as a rule of thumb, if you can have 70% owner occupiers to 30% or less renters, generally in that suburb there's going to be more people that are house proud, owner occupiers. And the other one that we like to overlay is average household income. So
the higher the better, as simple as that.
Yeah, the higher the better. If it's higher than the average of that city, it's probably going to be a nice area.
Yeah, definitely. And, you know, like Sydney, Melbourne, Perth, locals know the good spots and locals know the shit spots. Now, you know, everybody's got an opinion because everyone's house proud with where they live. But the reality is, Engadine, where we grew up, when we grew up there, was a shithole. Like, it was like 50% housing commission, a lot of renters. It was the affordable south side of the city. Now that, you know, the northern beaches got too expensive, the eastern beaches got too expensive, over the last 15 years, so much money went into the south side of Sydney that all of a sudden it's, in terms of average incomes, probably the wealthiest area per capita in Sydney now. Maybe the northern beaches is a little bit more affluent. So remember that just because you're buying something as it is now doesn't mean it can't change in the future. But I just prefer to buy, you know, if you can buy the northern beaches of Brisbane now, like I'm talking about, pretend you're thinking northern beaches of Sydney, 20 years ago, eastern beaches of Melbourne. Like, if you can buy whatever that is in Brisbane now, then why not buy the highest quality area while it hasn't improved in value in 11 years?
Which is cheaper to buy today compared to 11 years ago when you factor in inflation.
Yeah, so your job is to find out what quality looks like wherever you're buying, whether it's Perth, Adelaide, Canberra, Brisbane, and it's pretty easy to figure that stuff out. Like, you know, that's the cool thing about the internet. You know what I mean? You can figure out stuff.
So our jar's starting to get pretty full now with some of the big rocks. We've got strategy, we've got goals, we've got the fundamentals such as metro markets, houses, and high quality areas. Now, the last big rock, which I don't know if this is a rock or if this is just like the next step.
Yeah, like, can we just pause on that for 1 sec? Because there's a few things I wanted to add to strategy, which you and I actually talked about yesterday.
Yeah, cool.
So now that we know that we buy metro houses, we buy quality near the city or the beach, we time the cycle, we know where we're going in the next 12 months, we roughly know where we want to be long term. If you don't know where you want to be long term, just replace your current annual salary with a passive income. That's step one.
Mm-hmm.
After that, cruise on a beach and figure out what you want to do next. But strategy for me and you is, I also apply a low risk.
Yeah.
I look for properties with the potential for long-term capital gains. I know that I can't control the short-term future, so I do not worry about it.
Mm-hmm.
I also have a strategy, which is I buy when other people don't.
Mm-hmm.
Because why would I buy in Sydney or Melbourne in 2014 to 2016 when I've already missed like 30 or 40% of the easy growth and expose myself to the top of the cycle? So I buy when other people are scared, which I think is difficult to do. Another strategy that I have for me, or another thing that comes into strategy, is I always buy properties with great potential for cash flow.
Yeah.
Now, the cash flow is not always amazing when I first buy it. Like, the property you just bought has a 5% rent return.
Yeah.
But you're like, okay, that's an okay return. But you're going to add a granny flat and it'll take it up to about a 7.5% return.
Exactly.
So we buy properties with cash flow potential because worst case scenario, your property doesn't go up and you've got great cash flow and rents do go up with wages. You are still going to be financially free and you're not going to eat the equity. You're going to live off the cash flow into the future with your plan.
Yeah, I think that's really important. So having something where you can manufacture value, whether it's equity or cash flow.
Yeah, and that's the last little one in terms of my strategy. I like to, because I like getting my hands dirty. Like, I loved helping out at yours on the weekend. Like, you've enjoyed helping out at mine. Like, sure. It's actually fun to me because I work in an office all day. It's nice to actually stand up. You know what I mean? And do some shit and actually be like a real man.
Yeah.
Like, even though we're like pussy men compared to the other boys that were down there.
Yeah. Well, like at the end, I've got like the worst chafe. I've got blisters on my hands, and like you can tell I'm a desk jockey.
I got blisters on my fingers. But yeah, like, so the last one is I like to find something that isn't perfect so that I can clean it up.
Yeah.
And then I apply quality to that too. So hopefully, you know, over the course of this podcast, you can sort of nut out what works for you. Now, I don't care about, this is one thing that I'm good at. I get caught up in the long-term cycle hype. I don't want to say this because you get to see everything that's off camera and I do get caught up in it.
Yeah.
But I get caught up in it in my mind. It doesn't actually stop me taking action in my life. So I might spend weeks thinking about something fucking stupid, like everyone does, going down the little wormhole of things are bad or things are good, but I will not let it take me away from achieving my long-term plan, and I'll move through that.
Yeah.
So do not get too caught up in an election year, which you're going to start hearing. Do not get too caught up in trade tariffs. Do not get too caught up in a mining boom or a mining bust or a construction boom or bust or a good market or a bad market. You know, just don't get caught up too much in what the media says. Like, there's balanced opinions out there if you're looking for them.
The thing is, like, we've had change of governments so many times over the last 50 years. We've had different things occur in the global and local economy. But if you look at the long-term averages, Sydney, Melbourne and Brisbane over the last 50 years have all increased by over 9% per annum.
Yeah, so even if they do half of that, your property's almost doubling every 15 years.
Yeah. So, you know, take away the small short-term stuff, put your long-term cap on, and then apply these fundamentals.
Yeah, and so, yeah, sorry to, like, hijack that, but, you know, action is the last step. Like,
which speaks for itself, essentially.
We don't need to say anything about that. Like, you know, there's doers and there's talkers and there's thinkers.
Yeah.
You know, I'm grateful that I've observed mum and dad as doers.
Yeah.
Like, that's the biggest thing that I think all of us are in this business is we take action because we are so clear on where we want to be.
Yeah, if you're 100% clear and confident on your strategy, on your short and long-term goals, you've applied your fundamentals, there should be nothing holding you back from taking action.
Yeah, unless we're sitting at the very, very top of a cycle, and you know that, you know what I mean? Like, taking action in Sydney in 2017 was stupid.
Yeah.
If you knew this stuff, if you'd done this work and you knew your fundamentals around timing,
You wouldn't have done it.
you know, if you had been listening to anything that we said online since 2015, you wouldn't have done that. But unfortunately, you know, not everyone has the crystal ball. And I've done it personally. Like, I've lost money on properties. I bought Brisbane too early. I may have sold Sydney way too early. Like, you know, like, we all learn. That's cool. It's just make your next step better. Like, now you know better. If you're all the way through this podcast, like, we can do better.
Yeah. And if you're just starting out, focus on all of those fundamentals. Focus on all of the big rocks. And hopefully you can do your best at not making a bad decision.
Because if you've got a longer term approach like we do, like, what happens this year or next year doesn't concern me. I don't care. What concerns me is in 15 years' time, will I have an insurance policy that pays for my and my family's futures without ever having to go to work again? Or will in 5 years' time, I have a better quality of life because of the decisions that I'm making today? Now, 2 to 3 years from now, a lot of people will be like back in the property market globally and in Australia, and you will have missed the next 2 to 3 years, which I think is the best buying opportunity in the last decade. So just slowly this year, learn a bit more and get your confidence up, because it's not often that so many people are sitting on the sidelines for no particularly great reason outside of the fact that we are where we are in the cycle.
Yeah.
And that's exciting to me. Like, that's why Simon and I are buying.
Yeah.
But, you know, don't rush out and buy silly stuff. Like, be strategic, get your plan in place.
Awesome.
So what I wanted to say, like, we don't normally do a call to action at the end of a podcast, but we do run a buyer's agency business. That's what we do. We've helped our clients buy $300 million worth of property now, and we have bought some good stuff, and we're buying some really good stuff at the moment, and we're helping some really cool people set up their futures through what we're helping them buy. So if you are considering buying in the next 2 years, we'd love the opportunity to offer you a one-on-one strategy session with either Simon or I. And what we'll do is we'll sit down and look at where you are, where you want to be, what's holding you back or stopping you from achieving your goals, and, you know, educate you on where the market's at, and identify a plan, like a strategy using these fundamentals for your next step. Now, they're just our ideas, take them with a grain of salt, but, you know, from our experiences, you know, hopefully you'll be in a much better position. It's complimentary, it's not expectation of anything. Some months we do 30 of those calls, some months we are lucky enough to talk to 60 or 80 people, but we only ever take on a small number of people that we really want to work with, because we're overdoing the big volume or the big turnover or the big business. We just want to do good work with good people who actually get that now is an opportunity as opposed to a time to bury your head in the sand. So jump over to www.pumpedonproperty.com and book in a free session if you'd like one, whether that's now or at some point this year once your confidence builds. We wish you truly all the best. Like, we just want to see you guys smash it and get free. If you haven't already done so, please subscribe to this podcast, whether it's Spotify or iTunes. Please also check us out on YouTube and subscribe there. And please leave us a review on the podcast, only if it's a nice one, please. Just because we're putting everything we can into this, and the better the reviews and the more of them, the more Apple will show people this podcast, and the more people like yourself that are just starting to get into it, you know, can get a different perspective about property as opposed to the normal, high level, you know, fluffy stuff that everyone's talking about, the get rich quick crap. Sweet. Is there anything else you wanted to add?
No, pretty stoked. Let's get into the day. We get to actually figure